Hello everyone, I'm Rachel Oliver. I am a member of the Real Property, Probate, and Trust Law section of the Florida Bar, and I practiced in trust and estate planning, administration, and litigation in St. Petersburg, Florida. As we all know, on March 27th of this year, the Coronavirus Aid, Relief, and Economic Security Act, also known as the CARES Act, was signed into law. It was a huge $2 trillion relief and stimulus package that was aimed at helping individuals and businesses that were affected by the coronavirus. The purpose of this video today is to discuss the provisions of the CARES Act that directly affect taxpayers that have IRAs or other employer retirement plans. Under the CARES Act, there are special provisions that waived required minimum distributions, RMDs, for 2020, provided new rules for certain coronavirus-related distributions, and gave greater borrowing ability for loans from employer retirement plans. So first, looking at the waiver of RMDs for 2020, the CARES Act essentially suspended all required minimum distributions that are due for the tax year 2020 from IRAs, 401ks, SEP IRAs, 403bs, simple IRAs, Roth IRAs, both for account owners and for inherited IRAs. So this suspension rule it applies for clients who had already reached their required beginning date and were currently withdrawing their RMDs. They do not have to take an RMD for 2020. And it applies to individuals who had a required minimum distribution because they had an inherited IRA account. For individuals who attained their required beginning date, if they attained 70.5 before January 1st of this year, they would have been required to take their first RMD by April of this year. They get some bonus relief under the CARES Act because not only is that first RMD waived, what would have been their first one for 2019 that was due by April 1st of this year, but they also their RMD for 2020 is waived. However, if you took your first required minimum distribution during the 2019 tax year, instead of waiting until April of this year, there's no change. That RMD is taken, it was included in your gross income, there's no waiver. So the waiver is just for those who were required to take it and had until April and didn't do it, and for those who have one due for this year as well. So one of the important questions is, what if you already took your RMD for this year? You took it, earlier in the tax year before the CARES Act was passed, before this relief was available to you to suspend taking it. So you should be able to take advantage of what is the normal 60-day rollover rule. So normally when you take a distribution from an IRA or other qualified plan, you can avoid including that distribution in your gross income if within 60 days you return that distribution or deposit it back to another qualified plan. Normally, RMDs do not qualify for this special rollover treatment, just other distributions, but not your RMD. The CARES Act, however, says there are no RMDs for 2020. So if you took an RMD earlier in the year, it's no longer an RMD, and you are eligible under the normal rollover rules to repay that back or roll it over into another qualified plan. There are special rules for this, though, special rollover rules. This has to be done within 60 days of when you took the RMD, and you have to have not done another rollover within the last 12 months. Now, the only expansion on that 60-day rollover rule is under this new notice from the IRS, Notice 2020-2023, which was issued on April 9th, and basically says any deadlines that fell between April 1st and July 14th have been extended until July 15th. So if you took an RMD and your 60-day clock ran up on April 1st, you have until July 15th. If your 60-day clock ran up before April 1st, this rollover extension does not apply to you. So your 60 days have come and gone, essentially. It's also important to note that although inherited IRAs can take advantage of the required minimum distribution suspension for 2020, they are not eligible for the 60-day rollover treatment, and inherited IRAs are never eligible to do that rollover treatment. The second major relief provided to taxpayers with retirement accounts under the CARES Act is this new coronavirus-related distribution provisions. And I'm going to call these CRDs for short. So in addition to waiving the RMDs, the CARES Act also now allows individuals to withdraw up to $100,000 from their IRA or employer plan during 2020, and they get special tax breaks for this up to $100,000 distribution. And note that this $100,000 is in the aggregate of all IRA accounts, not per account. And there's certain rules in order to qualify for this special relief. So you can get special treatment for this large distribution from your IRA up to $100,000 if you, the owner, are diagnosed with coronavirus, your spouse or dependent is diagnosed with coronavirus, or you as the owner have experienced adverse financial consequences as a result of being quarantined, furloughed or laid off, working reduced hours, unable to work because of lack of childcare or business being closed, or any other factor that the Secretary of Treasury may add to this list. So if you meet that qualified type of person who's been affected by coronavirus, you can take up to $100,000 from your IRA account, and you have the option to report that $100,000 over a 3-year time period in your income, so 2020, 2021, 2022. And you also have the option to repay the distribution in that 3-year time period so that it's not included in your income at all. So you have 3 years to ratably report it and include it, and 3 years to completely repay it back and not have any income tax owed on it. On May 5th, the IRS issued additional guidance about these CRDs from IRA plans, and this guidance was issued in the form of 14 questions and answers. Question 7 specifically addressed the issue of repayment of a CRD and the ability to stretch out the inclusion in your income tax over 3 years. And I just thought the example was helpful. It basically says, taxpayer takes out a CRD for 2020, intends to include it in income over 3 years, includes it 2020, 2021, and then repays the whole thing in 2022. That taxpayer can amend his 2020 and 2021 returns, get a refund, and does not have to include the distribution in 2022. So hopefully that helps to make sense the 3-year rules and options there. So in addition to having the ability to take out this special CRD and have this special tax treatment with the 3-year time period, owners who take out a CRD and are under age 59 and a half also do not have to pay the additional 10% penalty. Normally when an owner takes out a distribution from an IRA and they're under 59 and a half, in addition to paying income tax, there's a 10% penalty on top of that. That penalty is waived for qualifying CRDs. The third major piece of relief under the CARES Act for individuals with employer retirement plans relates to relaxed rules for those individuals to take loans from their employer plans. So this is for employment plans only, not for IRAs. You can't take a loan from your IRA. So if you've already taken out a loan and it's outstanding after March 27th of this year, which is when the CARES Act went into effect, and you have a repayment that's due from March until the end of the year, March 27th until the end of the year, December 31st, that due date may be delayed under the plan for up to a year. And payments and during the suspension period will be adjusted, and the interest accruing will be adjusted during that delay. Additionally, any loans that are made after March 27th up to 180 days, the participant can now borrow up to 100% of what's vested in their plan, but not more than $100,000. And this is an increase from the old rules, which allowed borrowing of loans up to 50%, no more than $50,000. But what's really important to note about these loan provisions and even the CRDs as it relates to employer retirement plans is that these are optional to the employer. The employer is permitted to choose and to what extent they want to amend their plan to allow for CRDs, the coronavirus distributions up to $100,000, and those relaxed loan provisions. Lastly, even though it wasn't in the CARES Act, it's important to note that when the IRS extended the due date for filing federal income tax returns until January 15th of this year, it did so in IRS Notice 2020-18. That also extended the deadline for making IRA contributions for 2019 until July 15th, 2020. So I recommend that you take a look at the IRS website for the guidance under the frequently asked questions section. It's a 14 question and answer about the loan provisions, the coronavirus distributions, very helpful, provides some examples. I hope this is helpful, and it poses some interesting planning opportunities, especially now that we've had the markets down. If individuals are in a low tax bracket, this may be and would have lower income tax this year, then this may be a good opportunity to go ahead and take their RMD or do a Roth conversion. Our chair of the IRA committee, Al Statius, and Denise Kazabon have written an article that'll be coming out in Action Line discussing some of those options, and I recommend you take a look at that as well. Thank you.